For the first time in 60 years, Berkshire Hathaway is running without Warren Buffett and breaking some of his own rules. So we judge it by Buffett's own playbook, the methods, the money, the crowd. You be the judge.
The greatest company in financial history just changed hands. Now the board has to judge its own. You are about to see what happens when the playbook scores the company that wrote it. Berkshire Hathaway is one of the most studied companies in financial history, a holding company built around a single genius. Now, for the first time in 6 decades, it runs without him. Warren Buffett handed the keys to Greg Abel on January 1, 2026. But what does that change for the value he built? This episode is different. Every episode in this series uses the methods of the greats to judge a company. This one uses those methods to judge the company those methods built. The question is not just whether Berkshire is a buy, the question is whether it still passes its own test. But 6 months in, Abel's first quarterly filing told a sharp story. He exited 16 positions. The portfolio went from 45 holdings to 29. He more than tripled the Alphabet stake, a position Buffett himself had barely started, and he held Apple steady. The signal: Abel runs a different book than Buffett did. 16 positions liquidated in 90 days. That is not portfolio trimming, that is a philosophy statement. The man who inherited that machine decided, this is the new Berkshire, and it is leaner and more concentrated than the one Buffett left. 2 positions now represent roughly 30% of the entire equity portfolio. Apple at 22% held steady, not added, not sold, and Alphabet tripled from 17 million shares to 54 million. A $23 billion bet on the search giant, just as AI threatens to make search obsolete. And then the deal-making? A $6.8 billion all-cash acquisition of Taylor Morrison, a home builder. This is not a Buffett move. Buffett avoided home builders. Abel sees a housing shortage and a business with durable land positions. Whether that is wisdom or departure depends on whose method you use. But here is the problem. Berkshire underperformed the S&P 500 by nearly 12 points in Abel's first 6 months, minus 2.67 versus plus 9. This company built its entire identity on beating the index, and right now it isn't. Here is what the board saw, the numbers, not the narrative. Price to book 1.45, 2% above its own 10-year median. Berkshire has historically traded between 1.1 and 1.6 times book. Right now it sits exactly in the middle. That is a neutral reading, not cheap, not expensive, unless you are Benjamin Graham. Trailing price to earnings, roughly 14 times. For a conglomerate of this quality with $200 billion in cash, 14 times earnings is not alarming, but it is not a gift either. The cash: Berkshire holds roughly $190 billion in cash and short-term treasuries. At current yields, that generates approximately $7.5 to $8 billion in annual income with zero equity risk. That pile is what every investor in the company is actually paying for in part. Abel has not touched it. And beneath the cash sits the float. Berkshire's insurance subsidiaries GEICO, General Ray, Berkshire Hathaway Reinsurance collect premiums up front and pay claims later. The gap is the float. Roughly $170 billion in interest-free capital that Berkshire gets to invest. This is the machine's engine. Abel inherited it intact. 5 numbers lined up: price to book 1.45, price to earnings 14 times, cash $190 billion, float $170 billion, Alphabet $23 billion. New Abel's Berkshire. Now the legends run it through their methods. Warren Buffett, he built Berkshire over 60 years. His method: a wonderful company at a fair price, durable competitive advantage, trustworthy management. The time to sell is almost never. Now his method has to score his own company.
There is something uncomfortable about this exercise. Buffett's method scoring Berkshire is the equivalent of asking a father to grade his own children, but the method is mechanical. And the mechanical answer is, the business still qualifies. The moat is intact. Insurance float compounding at a rate no public company can replicate. The railroad has pricing power. The energy business generates regulated returns. The manufacturing portfolio, from precision cast parts to See's candies, earns owners earnings year after year. These are the businesses his method loves, and Abel has not disturbed them. The Alphabet bet is aggressive. The Taylor Morrison acquisition is outside the circle of competence as he defined it. But the cash position is enormous. The float is intact. And Abel ran the energy business for 20 years without a mistake Buffett could identify. The transition risk is the only real question, and his method prices that, not a 10 but a 7. The machine he built still runs. The new driver has made bold early moves. His method rates bold but defensible as acceptable. He scores it a 7 out of 10.
A 7, the architect approves his own succession, but the man who taught him everything sees this differently. Charlie Munger, he died in November 2023, but the method he used alongside Buffett for 50 years is reconstructible. His philosophy, great businesses at reasonable prices. And one thing Buffett often forgot, operator quality matters as much as business quality.
Munger's method has a position on succession that is clearer than Buffett's. He chose Greg Abel himself. He publicly endorsed Abel as the right operator years before Buffett's health required a decision. If the method includes who holds the wheel, that endorsement is part of the input. The alphabet concentration bothers him less than it bothers some. Munger spent his career arguing that Berkshire should have fewer, larger bets in businesses it understood well. An AI-era bet on the world's dominant search engine, that is not reckless. That is concentration in something real. The question is whether the thesis holds. The float is the float, the cash is the ammunition. Abel ran a business inside Berkshire for 20 years without a catastrophic mistake. His method grades management quality as highly as business quality. Abel gets the endorsement and so does the company. He scores it a 7 out of 10.
2 7s, the architects approve their own machine, but will the man who taught Buffett everything agree? Benjamin Graham, he wrote security analysis. He taught Buffett at Columbia. His whole life was one principle: never pay so much that being wrong can ruin you. The margin of safety is not a preference, it is arithmetic, and the arithmetic here is uncomfortable.
Graham's method begins with price. Price to book is his preferred lens for a financial enterprise. It tells him what he pays for the accumulated earnings of the business. At that price, he pays 45% above the accumulated value. That is not a margin of safety. That is not cheap. For Graham, cheap means at or below book value. The cash position is real. The float is real. But Graham does not value float the same way a Buffett-trained investor does. He values what is on the balance sheet. The balance sheet, at 1.45 times book, does not leave his required margin of safety. The 16 exits and the concentration in alphabet introduce uncertainty. His method rewards predictability and discounts uncertainty. He cannot verify that a new CEO's concentrated technology bets will compound. He can only verify the historical evidence. At this valuation, when Berkshire trades above its 10-year median PB, forward returns are modest. The teacher does not fault the student's business. He faults the price. At book value, he would buy enthusiastically. At 1.45 times book, he would not. His margin of safety is missing. He scores it a 3 out of 10.
A 3, the teacher just failed the student's company. Buffett scores his own company a 7. Graham scores it a 3, and we have 3 scores left. Philip Fisher, he built his philosophy around companies that could dominate their market for decades. Not just good businesses, businesses with an unfair structural advantage and the management to defend it. His lens on Berkshire is a succession lens.
Fisher's method asks, can you hold this for 20 years and be confident the advantage holds? For 60 years, the answer on Berkshire was yes, because the advantage was named Buffett. The float, the culture, the compounding, they were inseparable from the man. Now the man is not there. The float remains. The culture is assumed. The compounding is to be reproved. He is watching. Abel's moves in the first quarter are evidence. 16 exits decisive. The alphabet bet concentrated and thesis-driven. The Taylor-Morrison deal, conviction in a sector he believes in. These are operator signals. None of them are disqualifying, but none of them are 60 years of proof either. For Fisher, 18 months of a new operator is a data point, not a verdict. The franchise is real. The structural advantage is intact. The new operator has not yet earned the long runway certification his method requires. He holds, watches, and doesn't deploy new capital at these prices. A 5 out of 10, hold, not buy.
A 5, Fisher is watching but not buying. 2 sevens, a 3 and a 5, one voice left. The man who reads cycles, not companies. Howard Marks, he has spent his career asking one question before any other. Where are we in the cycle? Not is this a good company, not is this a good price, but what is the crowd thinking and are they right?
Mark's method reads the crowd. The crowd's verdict on Abel's Berkshire is clear. The stock is down 2.67% in a year the S&P 500 gained 9. The market is skeptical about the transition. It is pricing in uncertainty about whether Abel can compound capital the way Buffett did. That skepticism is visible in the price. But his second-level question is the skepticism right? If Abel is a genuine inheritor of the method, today's price is a discount to fair value. If the Buffett premium was irreplaceable, the price today is still fair. He cannot know the answer. And in uncertainty, his method charges hold a position proportional to conviction. He has moderate conviction. The price is fair, the uncertainty is real, the cycle is neutral. He would not avoid it and would not concentrate in it. A 5 out of 10, consistent with where the evidence places him.
A 5, the second-level thinker sees a fair price and genuine uncertainty. Now the board decides. 5 voices, 1 composite score. What did they land on? 5 legends, 1 company. Buffett 7, Munger 7, Fisher 5, Marks 5, Graham 3. The combined great score for Berkshire Hathaway in June 2026, 5.4 out of 10. And here is the story that score tells. Does 5.4 mean boring? No, it means the board is divided on one question: what Berkshire is worth without Buffett. The architects approve, the growth pioneer is watching, the cycle reader is neutral, and the man who taught Buffett everything says the price is wrong. 4 men agree the machine runs, 1 man disagrees on what you should pay for it right now. The board judged the method, but methods outlive their authors, so here is the question only the living can answer. Of the investors who actually move billions today, how many are buying Buffett's own company at this price in the middle of his succession? We pulled the filings. We tracked 15 of the most followed living investors, the ones whose methods this board is built on. Only 2 of them hold any Berkshire at all, 13 stay away. For the most analyzed company on earth, that absence is the tell. And the 2 who stayed, Li Lu of Himalaya Capital, Munger's own protege, holds $430 million of Berkshire, the closest thing to a Buffett-blessed signal still in the filings. The other, Chuck Acker, trimmed. Everyone else is watching from the sidelines at this price during this handover. And the crowd, Berkshire runs nearly 9 times the public attention of the average financial holding company. Markel, Lowe's, Fairfax, essentially unknown. Berkshire is a household name, but that fame is structural. 60 years of Buffett, not a new product. A famous name with the smart money hesitant beneath it. So watch 3 things. Can Greg Abel grow book value per share at the 15% Buffett set as the floor? Does the alphabet bet compound or crater as AI rewires search? And does the fault line finally resolve? The machine Buffett and Munger score a 7 or the price Graham scores a 3? Here is the debate. Graham gave Buffett's company a 3. Buffett's own method gave it a 7. One of the 2 greatest investors who ever lived is right. Which one? Tell me in the comments. This was the Greats Playbook, where history's greatest investment methods judge the companies of today. These are models of published methodologies, not the investors themselves, not affiliated, not endorsed, not financial advice. The numbers are from June 2026. Which company should the board judge next?